to the Edifice of Trust podcast. The Edifice of Trust podcast is a thoughtful discussion of today's current events from the perspective of America's founding principles. Welcome. From heart-pumping music to head-thumping commentary. Earlier this week on CNBC's Squawk Box, a program dedicated to business news, host Andrew Ross Sorkin featured a discussion on taxation between former Congressmen Jeb Hinsarling and Barney Frank. The contenders for the nomination to be the Democratic candidate for the 2020 presidential election appear to be trying to outdo each other in heaping taxes on the rich in order to fund the outrageously expensive new programs they are promoting, such as the Green New Deal, free college for everyone, Medicare for all, and anything else that they can think of to get them another vote or two. And Mr. Sorkin attempted to engage these two ex-representatives in a thoughtful discussion. Unfortunately, the discussion was anything but thoughtful, as Mr. Hinsarling, a founding member of the Tax Cuts Cure Everything wing of the Republican Party, and Mr. Frank, a long-serving Democrat with ties to the Democratic Socialists of America going way back, soon fell to talking over each other's comments so that the discussion quickly became an unenlightening, cacophonous hodgepodge of noise, which is how most discussions between the left and right end up these days. Luckily for the viewers, the station soon had to go to commercial break. But Mr. Sorkin had begun the discussion by referencing his editorial in the New York Times. Tax the rich? Here's how to do it sensibly. Given the title of the editorial and the platform it was published on, I think we can safely say that Mr. Sorkin supports soaking the rich to pay for whatever Congress comes up with, and he came up with 6 proposals to extract even more money from the rich. This podcast is based on my blog post that includes references to much of the original material, and if you want to see those links, you can go to the blog post which is on my website. Mr. Sorkin's first proposal was patch the estate tax. He began by writing, Gary Cohn, the former president of Goldman Sachs, who once led President Trump's National Economic Council, says aloud what most wealthy people already know. Only morons pay the estate tax. If you pay taxes, it's hard not to feel like a patsy. Of course, very few people actually pay the estate tax, so anyone dumb enough to actually have to pay it is probably a moron. Mr. Sorkin wants more people to pay more tax, but generously declines to address whether the current $11.2 million exemption is too high, and then addresses it by stating it's too high. His main complaint is that when a person dies, his or her heirs inherit the assets of the deceased without having to pay a tax. But if the heirs had to pay a tax on the inherited wealth that the deceased had worked a lifetime in order to give to his or her heirs, they might have to sell the family farm or company in order to raise the cash to pay the tax. But Mr. Sorkin also noted that the deceased estate gets a stepped-up basis, which means that the gains earned during a lifetime are wiped out and the inheritors start from scratch. That means that the inheritors could turn around and sell the family farm or business and not pay any tax. Although it might be difficult to determine what the original basis was, the step-up of the basis is a step too far. Although many people, mostly Republicans, want to get rid of the estate tax altogether, as long as you have a tax, it should be taxed on a consistently logical basis. The second proposal was increase the capital gains rate for the wealthy. Mr. Sorkin gripes that the top capital gains tax is only 20%, and notes that a person making $40,000 a year is in the 22% tax bracket. He implies that this is patently unfair. But although he says he consulted with tax accountants, lawyers, political leaders, and even billionaires in preparing his recommendation, he fails to note that a person earning $40,000 a year is, after applying the standard deduction, only in the 12% bracket, and would actually pay $3,619.50 in tax, or about 7.9%. He even dragged up Warren Buffett's statement that his secretary pays a higher rate than he does, a fallacy that has been dealt with in one of my very first posts, The Conundrums of Warren Buffett, published September 29, 2011. The problem with paying a tax on capital gains is that there may not be any actual gains in real terms. If you put $1 million in a bank account earning 3% interest, at the end of 10 years you would have $1,343,916.38. But if inflation was 3% during that 10-year period, you will have gained nothing, but you would owe $68,783.28 in tax. If you're going to charge capital gains taxes, they should, at the very least, be indexed to inflation. The third proposal, end the perverse real estate loopholes. In this case, I think Mr. Sorkin is correct. 1031 exchanges defer the capital gains on investments when, in fact, there has been a taxable event, the sale of a property. The rationale for the 1031 exchange exclusion is that the property owner is exchanging one property for a similar property and that the taxpayer's financial position is the same as before. But that is clearly not the case, or there would be no exchange at all. The fourth proposal was to eliminate fixed carried interest. This nonsensical provision allows fund managers, whose earnings are based on a client's gains in the fund, to be taxed at a capital gains rate even though it is their operating income, because they have no capital at stake. If they did put in their own capital in the fund, the gain on that capital would be taxed at the capital gains rate. Even President Trump agrees this is wrong. Get rid of it, which might be difficult given how much these billionaires give to political campaigns on both the right and left. Mr. Sorkin's fifth point was, let's talk about philanthropy. Charitable donations are tax-deductible in most countries, although some countries put some limitations on such deductions. And Mr. Sorkin and I agree that it is a good thing that wealthy people donate much or even all their wealth to charitable nonprofit organizations. But the benefit of deducting charitable donations can be abused. Bill Gates has put much of his vast fortune of primarily Microsoft shares into the Bill and Melinda Gates Foundation, and neither Mr. Gates or the foundation paid any tax on that donation. The Bill and Melinda Gates Foundation follows in the footsteps of other well-known foundations, such as the Ford Foundation, the Rockefeller Foundation, the Carnegie Foundation, etc., and donates to many worthy causes. But other foundations can be set up by anyone having enough money and can be used to further a family's business interests or employ family members at high salary. The Clinton Foundation has been accused of pay for play and, at the very least, a convenient way to park Clinton political operatives while out of office. The Donald J. Trump Foundation has been accused of using the foundation's funds for numerous ill-advised purposes. The use of these personal foundations has to be closely monitored. The sixth proposal was to fund the Internal Revenue Service. The IRS has been chronically underfunded and, as a result, has had to reduce the number of IRS tax audits, which has impaired its ability to collect taxes due. Mr. Sorkin is correct that this agency should be given the money necessary to fund its constitutionally mandated functions, and which would probably more than pay for themselves. Reducing government expenses by not funding the IRS is a stupid policy. So, in summation, some of Mr. Sorkin's ideas have merit, and some do not. The inability of the government to collect taxes was a principal reason that the Articles of Confederation were replaced by the Constitution. And the citizens of the United States have granted the government the power to impose taxes in order to fulfill its constitutionally mandated obligations. A problem arises, however, when the government taxes people in order to provide non-mandated services and functions. A progressive income tax that collects more money from the wealthy can be ethically justified by the idea that taxes place a heavier burden on the poor, who have to choose between paying taxes and other essentials such as food and shelter. But this is very different from the concept of confiscating wealth of the rich people for whatever ideas the politicians in Washington come up with. This confiscation is not based on America's founding principles, but on Marx's theory that profits are based on exploitation and are, therefore, illegitimate and subject to confiscation. And now for a brief message. Don't forget, my latest book, 2017, A Trumpian Year in Review, is now available in paperback and ebook versions on Amazon, Barnes & Noble, and iBooks. Also available are my previous publications, Principled Policy and Edifice of Trust. And if you want some adventure, try my novel, Tawantinsuyu. More information on these books, plus links to retail outlets, is available on my website, www.edificeoftrust.com. Thank you. Welcome back. The TV news shows are chock full of stories about how income tax refund checks from the IRS are down 17% this year compared to last year, and Democrats are slamming this as a middle-class tax hike. Kamala Harris, presidential candidate, tweeted the following: "The average tax fund is down about $170 compared to last year. Let's call the president's tax cut what it is. A middle-class tax hike to line the pockets of the already wealthy corporations and the 1%. There are 39,000 people following this tweet. However, this merely showed Ms. Harris's financial ignorance, a fact that should be taken into account when evaluating her potential as president. The tax refund is not a gift from the government, but a return of your own money that you have lent to the government at 0% interest. The less you lend to government in the form of excess withholding tax, the better off you are." For a reasoned and logical discussion of the principles on which taxation should be based, I suggest that you read my pamphlet, A Summation of the Principles of Taxation, available on my website, www.edificeoftrust.com, or on Amazon, Barnes & Noble, and other retail outlets. Thank you. Thanks for listening to my podcast. If you would like to hear more Edifice of Trust podcasts, please don't forget to subscribe. Thank you.